Welcome back, everybody, to Magnolia On Money. Today, we're going to talk about the tax trap that's hiding inside your IRAs, 401ks, tax-deferred accounts. So number one thing to think about is these are tax-deferred accounts. They're not tax-free. We have decided that we are not going to pay tax when we put the money in. We're deferring that to a later date. That date will show up at some point in time, whether that's you having to pay the taxes, or if you defer it out, and then you pass away and leave it to your heirs, then they have to pay the tax based off certain rules. So we need to be really careful about these tax traps. Now, during retirement, pulling money from these IRAs also have an effect on Social Security taxation. Social Security taxation is determined based off income that you have coming into your house. So if we have these big IRA accounts, 401k accounts, we're in retirement and we're having to pull money out of there, look, it causes Social Security to be taxed more. Social Security can be taxed up to 80% of your benefit may show up as being taxable. So IRAs, the tax trap, causes other things to be taxed even more. Also, Medicare premiums. Medicare premiums are also adjusted up based off your income. Once again, we now have a ripple effect. Because we have these big IRAs and 401ks, we have to take a certain amount of money out of those, which once again, we just said now causes more of Social Security to be taxed. Social Security is taxed more. Our IRAs are taxed. We have maybe pensions that are taxed. And now we're sitting at a place where now Medicare premiums go up. So it's just one thing after another can start to snowball because these tax traps that are hidden inside of the IRAs. Some of the other things are when someone inherits that account, they have a really small time frame. It's 10 years now. We think it will get shorter, where they have to pull the money out to make sure the taxes are getting paid within a 10-year window. So everyone be really, really careful with your tax-deferred accounts because they're tax-deferred, not tax-free. And at some point in time along the way, someone has to pay the piper and pay the IRS the money owed on that money. So we talk about this a lot. That's why we do a lot of tax planning in our office, trying to, how do we get the money out of here, pay the least amount of tax as possible, also not affecting, if we can, not affecting our Medicare premiums, hopefully not affecting taxation on Social Security. But these are big tax traps and we have to work on them as soon as we can because it takes time to get out of the trap. I hope that's helped. And as always, y'all have a great, great week and God bless. Talk to you soon.